So this is from a book. If you're really interested in this subject, I would tell you to get this book. It's called Private Capital Markets by a guy named Rob Slee. He's excellent. He's an M&A guy that only does middle market stuff. So this is again, a generality, significant generality. So number of companies, small businesses, which would be below 5 million, 5 to 150 million lower middle market, 150 to 500 million middle market, middle market, and then 500 million to a billion, the upper middle market, and then definition of large companies, larger than a billion. Okay? So this is based on some study of transaction multiples over time. Again, it's a generality. Don't peg yourself into a certain place, but this is generally where when you get into these small businesses, you know, it's not uncommon for them to be at the low end. Companies in the lower middle market in that range, when you get up to some scale, companies in, 150 to 500 million, you're looking at, you can get up to 8 and 9 times. Okay, so what can you glean from this? I mean, what are some of the characteristics that would say to you, just off the cuff, that would change these numbers? There's a couple. One of them has to do with the company itself. One of them has to do with who's buying them. What do you think about what do these numbers tell you probably about the company itself, just based on the fact that you see the sizes here? What's different about a company with below 5 million and say a billion? Forget their sales, but what else is probably different in order to get to a billion? Yeah, risk goes down, but why probably? They'd probably have fuller, to get a company to $1 billion, right? You got to have some mojo. You got to have great people. You got to have a management staff that really functions. That is not easy. That's not easy to do. Just a show of hands. How many in the room would be in the below 5 or category versus the middle? So who would be in the small business category? Just show of hands. Anyone? Probably not. I know most of you. Who would be in the 5 to 150, lower middle market? Most of our clients. And anybody in the middle? Couple? So the difference between companies that scale like this has a lot to do with planning, management staff, all those other things. The things that allow the company to get to that scale are the same things that allow it to be more predictable. Now there's another thing that's not intuitive, but companies that are larger attract bigger buyers. That's another reason why the multiples go up as you get bigger. There is a part of the multiple game that the larger you get, you attract bigger buyers, right? So if IBM was going to make an acquisition, and there's a base cost of every acquisition. It costs a certain amount of money, and then it varies depending on the complexity of it. But there's a base effort to locate the prospect and do all the work. Well, if IBM could buy a company that could contribute, $1 billion to its sales versus one that contribute 60 million, where do you think it's going to concentrate its time? So larger acquirers with lower cost of capital tend to be more strategic. They tend to be looking up here. It's not that there aren't deals down here, but this is a different buyer usually. This area of the chart is more private equity buyers. There's still, strategic buyers there, but when you get to large scale companies, they're trying to get some economies of scale in their time, so they're attracted to bigger opportunities, and that usually causes the prices to go up. Okay? But the big difference is just think about what it takes to run a $5 million company versus a $1 billion company in staff and systems and all that other stuff. Okay? Just quickly, when you talk about the cost of risk and the required rates of return, this is what that looks like for different kinds of investors. Debt, meaning somebody's going to lend you money, versus a mezzanine lender that's a combination of debt and equity, and an equity player. You can see that large companies, those returns are low because the risks are low. Small companies, in the small universe on the chart, the companies below 5 million, you can see that equity investors in those really small companies are requiring returns that are really high because they assign gigantic risks to them, okay? And then here's the middle. between the two. And this kind of relates to the previous graph, but just puts it in another way to look at it. Another thing, more for your information, this is most cost of capital studies are all based on public securities markets. This is a private study done by the same guy that did this book, but this was dated 2009. So when you think about what do investors require or lenders require for private companies, these are all private company deals. At that point, the average rate on bank lending, senior debt, was 5%. Asset-based lenders was 8%, right? That's a riskier piece of debt. But then you get up to like a mezzanine lender is somebody that lends money, but it's subordinated to the banks. They were looking, their average returns on their investments were 21%. So that they were looking for roughly a 5 multiple on what they would get back. Private equity, they were pegging at 30%. And factoring turned out to be the most expensive because there's a lot of other fees and costs associated with factoring your receivables. We don't have many clients that do that. It's prominent in certain industries, but it's the most expensive financing mechanism you can get. So when you think about, a private equity investor is demanding a 30% rate of return on their capital, what should you demand as, in terms of what's a reasonable rate of return for you as an owner of your company? Now these guys have hurdle rates because they got to send money back to their investors, right? They're looking to buy companies, build them, sell them, do whatever, and then they need to send money to their investors.